The OCC guarantees listed options. Options trade on various exchanges in the U.S., primarily the CBOE. If trading is halted on the underlying stock, options trading on that stock is halted. For options that list on the CBOE, there are standardized strike prices that are generally fixed at 2.5-point intervals when the strike price is between $5 and $25, 5 points when the strike price is between $25 and $200, and 10-point intervals when the strike price is over $200. Strike prices are adjusted for splits. The exercise prices for listed options are determined by the exchanges, not by OCC. Both in, at, and out of the money, strike prices are initially listed. Contract premiums are stated in decimals. 1 point equals $100. Options contracts have standardized expiration dates. The options expiration dates that are available to an investor depends upon the month the investor purchases the option contract. Options can be exercised at any time after ownership is confirmed, up to the cutoff time. FINRA rules allow for exercise up to 5:30 p.m. Eastern Time on the day of expiration. Broker-dealers may establish an earlier time to accept exercise instructions, but may not accept exercise instructions after 5:30 p.m. Eastern Time. The open interest is the total number of options currently outstanding in a series. If the underlying stock declares a cash dividend, there is no adjustment made to the options contract. For the holder of a call option to receive a dividend, the option must be exercised prior to the ex-dividend date. If the underlying stock declares a stock dividend, the option contracts will be adjusted. The exercise price will be decreased and the number of shares in the contract will increase. Both stock splits and stock dividends increase the number of shares and decrease the exercise price of the options contract. One of the main advantages of using an option contract is to provide leverage. OCC sets limits on large investors to prevent them from controlling the market. Position limits and exercise limits range from 25,000 to 250,000 contracts on the same side of the market. The limit for positions for the same underlying security on the same side of the market for the largest in capitalization and most frequently traded stocks is 250,000 contracts. A class of options includes all options of the same type, puts or calls that cover the same underlying security. For example, all Apple calls or all Google puts. A series of options is a class of options having the same expiration date and exercise price. For example, all TTD September 40 calls. The holder of an American-style option can exercise their right to buy, call, or to sell, put, the underlying shares of stock anytime the contract has intrinsic value. When purchasing or selling options contracts, settlement is the next business day. When exercising options, settlement is T+2 business days after OCC receives the exercise notice. The trade date is the date OCC receives the exercise notice. OCC will automatically exercise at expiration any option that is in the money by at least a penny. This is called the exercise by exception procedure and applies to both customer and firm positions. The investor or firm can opt out of this exercise by exception. Options clients must be given the options disclosure document, ODD, titled Characteristics and Risks of Standardized Options, the equivalent of a prospectus. The ODD is published by OCC and must be given to all customers prior to the first transaction, at the time of or before they open a new account. When the ODD is updated, the updated disclosure document must be given to the options client no later than with the confirmation of the next transaction. The customer must agree to abide by the rules and regulations of OCC. They do this by signing the options agreement. The options agreement must be signed by the customer and returned within 15 days after the account is approved for options trading. If the options agreement is not returned within 15 days, the customer can close or retain existing positions, but not open any new ones. If the nature of a firm's business includes options trading, the firm must have at least one registered options principal, Series 4 exam. The options principal will be responsible for supervising a member's options sales practices with the public for the following products: equity options, foreign currency options, interest rate options, index options, and options on government and mortgage-backed securities. In addition to the supervision of options sales practices, the Series 4 also qualifies the principal to supervise the member firm's investment banking and securities business as it relates to options. Options confirmations sent to customers must include the following: type of option, underlying stock, expiration month, exercise price, number of contracts. A hedge is a second securities position to limit risk or protect a profit on an existing position. If an investor is long a stock, they can buy a put to protect against loss, like buying insurance. If an investor is long a stock, they can sell a call. The sale of the call only offsets the downside risk by the amount of premium collected. If an investor has shorted a stock, they can buy a call to protect against loss, like buying insurance. If an investor has shorted a stock, they can sell a put. The sale of the put only offsets the upside risk by the amount of premium collected. With a spread, the investor buys and sells the same type of option, either creating a call spread or a put spread. With a spread, both of the options contracts are on the same underlying security. A spread will have either different strike prices, vertical spread, or different expirations, horizontal or calendar spread, or both can be different, diagonal spread. With a straddle, the investor either buys a call and a put or sells a call and a put. A straddle is on the same underlying security with the same strike price and the same expiration month. A combination is two options contracts on the same underlying security but with different strike prices and or different expiration months. With a spread, if the investor paid more than they received, it is a debit spread. With a spread, if the investor received more than they paid, it is a credit spread. A debit spread will profit if the spread widens and both options are exercised. A credit spread will profit if the spread narrows and both options are unexercised. The basic axiom of buy low, sell high makes it very simple to determine whether a spread is bullish or bearish by comparing the strike prices of the options. If the strike price on the long option is lower than the strike price on the short option, then it is a bull spread, buy low, sell high. If the strike price on the long option is higher than the strike price on the short option, then it is a bear spread, buy high, sell low. A vertical spread Price spread has different strike prices, same class, same expiration month. A horizontal spread, also called a calendar or time spread, has different expiration months, same class, same strike. A diagonal spread has different strikes and different expiration months, same class, puts or calls. A straddle consists of two options, either a long call and a long put, or a short call and a short put. Straddles are traded as a unit but may be exercised separately. A long straddle is purchased when a customer expects a major move in the market price of the underlying security but is not sure of the direction up or down. The most an investor can make on a long straddle is unlimited due to the long call. The most an investor can lose on a long straddle is the two premiums paid. For a straddle, there are two break-even points, one on the upside and one on the downside. In a long straddle, the profit is outside the box. The loss is in the box. In a short straddle, the profit is inside the box and the loss is outside the box. The most an investor can make on a short straddle is the premiums collected. The most an investor can lose on a short straddle is unlimited due to the short call. LEAPS are options contracts that have an expiration that is longer than 1 year, up to 3 years. Equity LEAPS expire in January each year, American style. Index LEAPS expire in December, January, and June. LEAPS become available each September with an expiration date in 3 years. Index options can track broad or narrow-based indexes. OEX is shorthand for the Standard & Poor's 100 stock index. SPX is the ticker symbol for the Standard & Poor's 500 stock index option. XMI is NYSE ARCA's Major Market Index 20 blue chip industrial stocks. Index options are designed to be either American style or European style. Options on indexes settle for cash. One contract equals $100, the index multiplier times the index level. Monthly, weekly, and quarterly index options expire on the date listed on the contract. Purchases of puts or calls with 9 months or less until expiration must be paid in full. Writers of uncovered puts or calls on equities must deposit, maintain 100% of the options proceeds plus 20% of the aggregate contract value, current equity price times 100, minus the amount by which the option is out of the money, if any. Subject to a minimum for calls of options proceeds plus 10% of the aggregate contract value, and a minimum for puts of options proceeds plus 10% of the aggregate exercise price amounts. A capped index option, CAPS, is an exchange-traded single contract, vertical option spread, with European-style exercise plus an early exercise price trigger. With a capped index option, there is an upper and lower boundary for possible outcomes. Caps are most similar to a vertical spread, but in one contract. It is either 2 index calls or 2 index puts, with the same expiration date and with strike prices that are 30 points apart. The 2 options trade as a single, inseparable option spread contract. The early price trigger terminates the contract and provides for settlement at the maximum value of the caps if the underlying index closes at or through the upper strike price on call caps or the lower strike price on put caps at any time during the life of the contract. If the early exercise trigger does not terminate the cap sooner, automatic European-style exercise occurs at expiration. Capped index options limit the profit potential for the owner, but they also limit the cost. When an investor believes that the market will move modestly, caps are suitable investments. Yield-based options focus on the changing yields in the bond market. CBOE's most actively traded yield-based option is on the TYX. The TYX is CBOE's 30-year Treasury bond index. The index is equal to 10 times the yield of the 30-year Treasury bond. If the 30-year Treasury bond is yielding 3.221%, the TYX index would be at 32.21. Index options based on the TYX are European-style cash-settled options. Remember the inverse relationship between yields on bonds and their prices. If an investor is expecting that interest rates will rise, prices of bonds will fall. Thus, buy puts. If an investor is expecting interest rates to fall, prices of bonds will rise. Thus, buy calls. Foreign currency options allow for speculation on changes in the exchange rates of foreign currencies. The underlying interest is a specific foreign currency. If an investor expected the economy of a foreign country to improve, they might purchase a call in its currency. If an investor expected the economy of a foreign country to get worse, they might purchase a put in its currency. An importer who has to pay in foreign currency would buy a call on the foreign currency. An exporter who is going to receive foreign currency would buy a put on that foreign currency. The premium for a foreign currency option is expressed in US cents per unit of foreign currency. The third Friday of the expiration month is the standard expiration date for equity, equity index, ETF, and ETN options. Foreign currency options may be either American style or European style. The buyer of an option has the power to exercise the option, let it expire, or trade the option during the option period. When exercising a call, the cost basis will be the strike price of the stock plus the amount of premium paid. When exercising a put, the cost basis will be the strike price received when selling the shares minus the premium paid. When an option expires worthless, the option premium paid is a short-term capital loss. When an option is traded, the difference between the premium paid and the premium received is a short-term capital gain or loss. When an investor has sold a call that is exercised, the cost basis is the premium received plus the strike price received when the stock is delivered. When an investor has sold a put that is exercised, the cost basis is the strike price paid minus the premium received. If the seller subsequently sells the stock, there will be a gain or loss. The holding period of the stock begins when the put was exercised. A married put occurs when the investor buys the stock on the same day that they also bought a put. The cost basis for the stock includes the market price paid plus the price paid for the put. They are married. Non-qualified annuities are sold to clients to supplement their retirement income. Non-qualified annuities offer tax-deferred earnings and payments monthly for life, should the annuitant choose to annuitize. Non-qualified annuities are not subject to any annual contribution limits. are funded with after-tax dollars and their earnings grow tax-deferred. When the earnings are taken out of a non-qualified annuity, they are taxed at ordinary income rates, which is a disadvantage. Partial withdrawals from an annuity are taxed LIFO, last in, first out, meaning earnings are taken out first. Partial or full withdrawals made under age 59 and a half are subject to a 10% early withdrawal penalty on the earnings. There is no physical examination requirement in order to buy an annuity. Annuities always have a beneficiary during the pay-in period, accumulation period, and may or may not during payout, depending upon which payout option is selected. Annuities do not have to be annuitized, but they may be annuitized at any age without penalty. Once annuitized, the monthly payment continues for the annuitant's life, and there is no longer the ability to take cash surrender. Annuity contracts have sales charges. These sales charges can be front-end loads, contingent deferred sales loads, or a combination of the two, so long as the charge is reasonable. In addition to sales charges, annuities also have charges and expenses that are expenses of either the general or separate account. These charges and expenses on annuity products are generally more than those found on mutual funds. There are 3 ways to pay in the premium for an annuity: single premium, level premium, or flexible premium. The only way to fund an immediate annuity is with a single premium. Immediate annuities begin payout 1 month after funding. A deferred annuity can be funded with any type of premium. If an annuitant dies during the pay-in period, the beneficiary will receive either the total value of the annuity or the amount invested, whichever is greater. The beneficiary assumes the annuitant's cost basis and tax liability accordingly. The value of an annuity during the pay-in period is called an accumulation unit. The value of an annuity during the payout period is called an annuity unit. To encourage annuitants to hold their contracts long-term, there are surrender charges built into the beginning years of the contract. Surrender charges are in addition to any taxes and early withdrawal penalties that may be owed when an annuitant takes money out in the beginning years of the pay-in period. Upon annuitization, the amount the annuitant will receive monthly will depend upon the following factors: account balance, earnings, gender, age at annuitization, and the payout options selected. The health of the annuitant is not a factor in determining the monthly payout amount. The straight life-only annuity payout option will have the highest monthly payment and the highest risk, since there is no beneficiary. The joint and survivor annuity payout option will pay out monthly until the last party dies, a popular choice for married people. The refund annuity payout option will pay the annuitant's balance to a beneficiary should they die before receiving the full value of their annuity. There is also the period certain annuity payout option where there is a beneficiary for some of the money but not all of the money. The longer the period certain, the lower the monthly payment would be. When annuitizing a variable annuity, the insurance company will select an AIR. The assumed interest rate is conservatively set by the insurer and is used as an illustrative rate to show the future growth potential of the contract. When the actual earnings are equal to the AIR, the monthly payment remains the same as the prior month. If the actual earnings are more than the AIR, the monthly payment will be higher than the month prior. If the actual earnings are less than the AIR, the monthly payment will be less than the month prior. Annuity contracts have a maximum mortality expense guarantee, which means that if the annuitant lives longer than expected, the insurer assumes the increased cost. Employees of nonprofits and public educational systems are able to fund TSAs, tax-sheltered annuities, that are funded with pre-tax dollars, zero-cost basis. Withdrawals from a TSA would be 100% taxable as ordinary income and subject to early withdrawal penalties if under age 59 and a half. A fixed annuity is not a security. It is an insurance product that is regulated under state law. It can be sold with just an insurance license. A fixed annuity has a fixed rate of return and no ability to enjoy the gains in the market. Fixed annuities have inflationary risk, purchasing power risk. The premium paid into a fixed annuity is deposited into the insurance company's general account and will earn a minimum guaranteed interest rate. If the general account earns less than the promise, the client is still paid the minimum guaranteed rate. The insurer has the risk in the general account. With a bonus annuity, the insurance company pays in 3 to 5% of the client's premium as a reward for purchase. Bonus annuities often have higher fees and expenses and longer surrender periods than annuities sold without this bonus payment. An equity-indexed annuity is not considered a security and can be sold with only an insurance license. An equity-indexed annuity has a minimum interest rate that it promises to pay to the annuitant, floor, as well as a cap, which is the most it can earn. Equity-indexed annuities also have a participation rate that describes how much of the earnings of the index the account will be credited with and varies by insurance company and product offered. Index annuities have surrender charge periods that are longer than those found in fixed and variable products. Variable annuities do not have a minimum rate of return. Their rate of return in the separate account will be variable and will depend upon the performance of the various sub-accounts selected by the client. The annuitant has the risk in the separate account. In a variable annuity, the value of a unit will vary both during pay-in and during pay-out. Variable annuities are both insurance and securities products regulated under both state and federal law. In order to sell variable products, a person would need both their life insurance license and their Series 6 or Series 7 license, SIE plus Series 6 or 7 top-off exam.